Catherine has pressed the button to start the record. Welcome, everyone. We are in week 7. This is issue 2022-7 of Tax to the Max. There is no special guest this week, but this is the first week that we will include some coverage of a South Carolina item, and we begin to include those each week. Tax to the Max is a weekly symposium. I searched around to get the right word. I hope this is the right word. Of developments in U.S. and South Carolina tax law. There's a fairly standard disclaimer. What's important here is the value in, as I prepare these programs every week, of my subscription to Tax Notes Today. It's published by Tax Analysts, which is, in my opinion, the preeminent source of current information for tax professionals. And I noticed Tax Analysts has just designed a utility within their offering that makes tax research much easier. You can check it out for free on the Tax Analyst website. I encourage everyone to give it a shot. It's, in my opinion, very worthwhile. Now, we're going to start with the Department of Revenue winning a little case. It's small in the grand scheme of things, but it's a big deal if you've been in a sales tax or use tax audit. And then the IRS has reversed its position, just completely did a U-turn on lease payments based on adjusted revenue and whether they are qualifying rents from real property for purposes of determining the statutory limitations on a real estate investment trust. Then what is tax insurance? We talked about it a couple of weeks ago. And when should you use it? I found a very succinct, very easy to understand summary of tax insurance, again, on the Tax Notes Today. And then, see, someone is not muted. Could you do me a favor and mute yourself until you're ready to speak? Everyone's always perfectly willing for you to participate. If you can mute yourself until you're going to do that, then we don't hear whatever's going on in the background. Should a tax-exempt entity be organized as an LLC? Maybe so, maybe not. The federal government says okay. Some of the state governments say not so much. And then there is a new compliance campaign focused on partners basis. That should not come as a surprise to anyone. The IRS has been playing around with this concept of tax basis capital, requiring special reporting, special analysis. That is by no means over. Now they've moved on from encouraging and requiring us to make the calculation to auditing the calculation. What a dust up this last week, 2 weeks, on the Schedule K2 and the Schedule K3. Oh my Lord, we've all got to make out these new 24-page schedules, what to do. Well, what to do, it turns out, was just wait until the dust settled, because the IRS decided yesterday at 12:50 in the afternoon that they were not going to require the schedules K2 and K3 for 2021 to be attached to 2021 partnership or S corporation returns. And then we continue to report on the updating of IRS FAQs and fact sheets. The reason for the FAQs is the IRS has said we can use those, we can rely on those, we can cite those as authority, provided that we are always going to be able to tell which version of the FAQs we were looking at. Finally, new instructions for IRS auditors that are checking NOLs. And I always find it interesting when the IRS modifies instructions in the Internal Revenue Manual, because we have to deal with the downside, if you will, of that. We have to know whether or not the IRS auditor is in fact doing what they're supposed to do, so we can know what we're supposed to do. Well, that's the summary. If you have questions, please post them either in Scapa Connect or in chat. I believe that Catherine or someone is going to monitor the chat for me, since it's hard for me to do 2 things at once. I have enough trouble doing this one thing, never mind trying to do 2 things. So if there's a question, Catherine I guess Catherine, someone will see the question, they'll read the question, they'll unmute themselves, read the question to me, or I'll get with you and let you unmute yourself and read the question. We have plenty of time for questions, and I encourage those, because the important thing here is to understand this stuff, not just for me to run through it until I'm through talking about it. So the Department of Revenue can transmit documents by email. This was AgPro LLC, which went through a sales and use tax audit with over 11,000 transactions. The Department of Revenue did, in fact, submit the traditional on plain paper in the right form assessment. But 11,000 documents on paper, it was eminently reasonable, according to Judge Deborah Brooks-Durden, for the Department of Revenue to use email to provide all of that information to the judge and to the taxpayer. And as I say here, any tax professional that was ever involved in a sales tax audit knows exactly the volume of transactions, and you don't want it on paper. You don't have any place to store it. A U-turn on the definition of rents. Hello, I'm turning no into yes. That's our friends at the IRS on the subject of whether or not a certain type of lease will produce income that qualifies as qualifying income for a real estate investment trust. Partial revocation of one ruling. Now, there were more than 47 rulings in what's been referred to in the profession as the casino spinoff letter ruling back in 2013. If you want to look at it, there's the letter ruling number. You can find it, you can cite that in any of the popular citators. The IRS said that some facilities of a newly formed REIT would in fact qualify as Section 856 real estate income, rent, although several lease provisions were based on adjusted revenue, not receipts or sales. You could have rent based on gross receipts. You could have rent based on gross sales. You could, which would be sales without adjustment for returns, or you could have rent, but you could not have rent that was reduced by any expense. Now you can. To limit the effects of this U-turn, of this reversal, the IRS has very kindly said that this relief is going to be granted under Section 7805B. Well, I had to look that up. What is 7805B anyway? Well, no retroactive effect by law. No retroactive effect of a regulation or an IRS position that does this, does a complete reversal. You need to be certain of the economic outcome of income tax considerations in a negotiated deal. Of course you do. You have to balance all of the costs, all of the revenues, all of the factors. And one of those big factors can be whether or not a tax position of the target company in a negotiated deal can be, in fact, supported and defended. Well, you can do a really good job of research on the issue, but what if that's not good enough? I can't be the only CPA that ever did all the work necessary to convince himself or herself that he was right, and turns out we were wrong. Or you could pay a tax professional to research the issue and give you a written opinion. Wonderful. If it's wrong, then you face years of litigation to determine whose fault it was. Did you give them the right information? Did they get all the information? And then how much were your damages? Or you can buy insurance. Well, gee whiz, that sounds like a really good idea. Who buys it? What is it? And who buys it? So here's an article by Jove Shantz, 1 page, 4 paragraphs, in which he explains that a taxpayer with a need for absolute uncertainty of the tax costs or benefit of an otherwise fragile transaction should buy tax insurance. If there's a need to shift the tax risk when the prospective buyer doesn't share the seller's comfort with one or more of the target's tax positions, or management is going to make a decision to commit resources to a possible business opportunity with uncertain tax treatment. Management's willing to spend the money if it's deductible but they're not willing to spend the money if it has to be capitalized because of its effect on earnings. Oh, there's that. Then you need support for tax positions and tax opinions of the taxpayer's traditional tax advisors. Yeah, we got Nichols, and he's been our advisor for a long time, and usually he does a good job, but this is a lot of money, probably exceeds Nichols' net worth, and so we're going to buy insurance to ensure that the advice we got from Nichols was in fact correct. Can an LLC be a 501c3 organization? No. No, a 501c3 is a corporation. No, not so. It's just an organization. A 501c3 organization is one that meets certain qualifications in its organizing document and in its operation. The standards a limited liability company must satisfy to receive a determination letter are exactly the same as the standards a corporation has to satisfy. You don't have to be a corporation. You're only going to be recognized as a 501c3 organization if both your articles of organization and any operating agreement for the LLC include all four provisions, the traditional provisions that are listed on my next slide coming up. But what about a state's tax rules? I don't know. Let's change the slides, find out. 1, provisions requiring that each member of the LLC either be an organization described in 501c3 or exempt from tax under 501a, or a governmental unit described in 170c1, or wholly owned instrumentality of a governmental unit. Okay. 1. 2, express charitable purposes and charitable dissolution provisions. We've expressed charitable purposes for a charitable class, a charitable undertaking, and what happens with our assets when we dissolve. The express Chapter 42 compliance provisions that are described in the code, even if the LLC is a private foundation. And finally, 4, an acceptable contingency plan to be implemented if one or more members cease to be 501c3 organizations or governmental units. And finally, in bold type, the LLC must also represent that all provisions in its articles of organization and operating agreement are consistent with the applicable state LLC statutes. Oh, and that they are legally enforceable. Oh, that's more than the requirements would be for a corporation. So the LLC has to do more. And for example, in New Hampshire, which was the example that was used in explaining this to me, state laws only apply to a corporation. If you're not a corporation, you can't be recognized as a 501c3 charitable organization in New Hampshire. So if that's in fact a checkerboard of state statutes across the country, can an LLC be a 501c3? It's just another thing that you and the lawyers need to check before you commit to a course of action here. Partnership reports a loss. I love this illustration. That's a whirlpool, and that's money. Those are $100 bills being sucked into that whirlpool. The partnership's a loser. Now what? Well, you need to know that losses from a partnership can be limited 3 ways. Partners reporting flow-through losses must have adequate outside basis, as that is determined under Code Section 705. Otherwise, the losses are suspended. Now, I put that term in green because I don't like it. It's the wrong word. The losses are limited, and I'll explain in a minute why that's important. But that use of the word suspended in the statute and in the IRS, what the IRS writes about this, is a very unfortunate choice of words because it lends to the confusion that I'm going to explain in a minute. That's not the whole story. And auditors are also checking, like you got to have outside basis. The auditors are also checking the at-risk limitations under 465 and passive loss limitations under 469. Wait a minute, Lynn. How can I have basis without being at risk? If you're an experienced partnership tax advisor, you know the answer to this one. My basis in my partnership interest can be increased by the partnership incurring debt. All partners get basis from the partnership debt, but I might not be at risk. So there are three hurdles you got to jump over here. You got to have basis. That's a mechanical calculation. You got to be at risk. That's a subject of matter for the statute. And then you got to participate. You got to avoid the passive loss rules. So I'm saying be careful with your use of the words limited and suspended to describe losses. Here's why. When you dispose of an interest in an S corporation or a partnership, a suspended passive activity loss is immediately available to be claimed in your tax return. A limited loss that you couldn't claim because you didn't have basis is lost forever down that chasm. Why? Because you didn't restore basis before you disposed of the interest, and therefore there is no loss. Your basis was limited. A suspended loss can be triggered. A limited loss can never be triggered. It can only be restored by restoring your basis. And if you're considering a disposition, you might want to restore basis and claim your loss and get some adjustment in the sales price for that. Isn't this tax work fun? Don't you love it? Oh yeah, speaking of loving it, Schedules K2 and K3, we were all pulled through the knothole the last 2 weeks. Partnerships and S corporations are required to report partners and shareholders' total distributive share of international items on Schedule K2 and report a partner or shareholder's allocable share of those items on K3. Now, K2 is the partners or shareholders' total distributive shares of international items. K3 is an individual partner's share. Now, the uproar came about because it wasn't necessary for the partnership to own any international asset or have any international income to be required to report. If the partnership owned property that produced income, if the partnership had income from international sources, and even whether or not they had income or not, if they simply had an investment in an international source, that could have affected the Form 1117 to be filed by an individual partner, where you have to have the total amount invested, the total income by jurisdiction, in order to maximize your federal tax credit. So this is all about the claiming of federal tax credits and justifying federal tax credits in the returns of partners. That's what the schedules are for. They're intended to help partners determine their U.S. income tax liability, actually to determine their federal tax credit available when a partnership has any kind of foreign item, even if it's a deduction and not a credit, as well as to provide the information in a standardized format. So based on the original instructions, we all, not just many, I'll own up to this, we all assumed the schedules needed to be filed only if a partnership or S corporation had foreign operations. And then 2 weeks ago, the IRS publishes, they deliver themselves of their view that no, all partnerships, all S corporations must file this, even if they only have a partner that has foreign income or is going to claim a foreign tax credit. I occasionally have a reaction sort of along the lines of, are you kidding me? So first we got the Form 8865, which was 20 some odd pages of instructions for the K2 and the K3. Partnerships are going to have to file these new international reporting schedules, even if they had no foreign partners and no foreign activities. Lots of complaints. The IRS was just catching hell from the practitioner community. So they relieved practitioner concerns. I thought that was a wonderful term for it. We pick up this article by Kristen Phillips on the 16th of February. Now, if you're looking at your calendar, you'll know that's just earlier this week. Reporting on an informal statement by an unnamed IRS official, the IRS intends to provide additional transition relief from Schedule K2 and K3 for domestic partners and S corporations with no foreign activities, foreign partners, or shareholders, and without knowledge of partner or shareholder need for the information, whether they need it or not. I enhanced some of that text for readability, right? That's not the bolding and the underlining is not in the original text. I thought that would help understand it a little bit better. And am I frustrated? Yeah, have you figured that out? You're right. The IRS official statement continues for 2021, these qualifying domestic partnerships with S Corp and S corporations will not have to file the new schedules. We're taking this step in response to feedback. That's an interesting term for it. We received from the tax community and our stakeholders. The IRS will provide full details of this relief soon. And I had written in green, stay tuned. That was Wednesday morning. It was yesterday morning as I was doing a final review of these slides. Then at 12:50 yesterday afternoon, Tax Notes breaks this headline. The IRS has issued 18 FAQs on how and when the K2 and the K3 will be required to be filed with a 1065 or an 1120S. And the IRS will have a special podcast explaining these new schedules and when they are required next week. Meanwhile, go back for a moment. Next week, the IRS will explain what these schedules are and when they are required. But meanwhile, there will be no penalty if you get it wrong in 2021 returns. Now, Catherine, we've been talking about this in back and forth. I shared I thought we had a need to get this program done and to get it done right away. We're going to continue to monitor this for all of you that are with us, that are interested in this. The moment we have any indication that the IRS has settled on how this is going to work, we will prepare information about that and share it with all of you in a podcast or a Zoom call, whatever Catherine and Scapa want to do. We will have it available. You don't fret. You have the if you monitor what we're putting up in Connect, you'll have the information. You'll have an opportunity to get good information. I have a real expert on standby to help me with this. So the IRS has updated FAQs again, 52 pages of updates on the frequently asked questions on the recovery rebate credit, which is in the rearview mirror. And we still have questions about it, I suppose, 52 pages worth. But those FAQs, by the way, you can cite those as authority for any amended returns you need to make because you got the reporting of the recovery rebate credit wrong. And then a new filing season fact sheet, only 8 pages, which lists and summarizes key changes to tax benefits that are going to affect 2021 returns. And by the way, in the last paragraph, urges everyone to file this year whether you have a tax liability or not, to claim all the benefits for which you are eligible. It's really important to the current crop of politicians that everyone who is dependent on the federal government for something gets that benefit. Exams of returns claiming NOLs. I love this cartoon. We've used it more than once. This is our indomitable IRS agent pursuing the taxpayers, one of whom is hiding records. He's leading the parade here. The others, they're all in fear, but of course, then one is smoking a cigar, indicating the business people and their lack of regard for the IRS. I love this cartoon. See the next slide for the taxpayer options and your responsibilities. Eligible taxpayers carrying back an NOL, and we certainly have had our share of those, can either file a Form 1045 or an 1139 if it's a corporation within 12 months of the end of the loss year, and that's a hard stop. Or you can amend the carryback year return within the normal limitations period for filing refund claims, which is longer than 12 months. If you need the money from the carryback right away, you need to use the 1045 or the 1139 if it's a C corporation. There is a picture of the 1045. Right now, it looks pretty straightforward, pretty simple. There's just some questions to answer. But here's the bottom half of page 1. Now it gets a little complicated. You go back to the earliest preceding year in the far left-hand column, and you recalculate your taxable income and your tax liability. Then the next preceding year, and finally the immediately preceding year, calculating your taxable income and your tax liability. There is another page where this complexity continues. I decided not to try to illustrate the whole thing here. So which is best? The 1045, 1139 for a C Corp, can only be filed during the period ending 1 year after the end of the tax year in which the NOL, net capital loss, unused credit, or claim of right adjustment arose. And by the way, if you don't know what a claim of right adjustment is, ping us, and I'll be sure to explain what a claim of right adjustment is next week. After that, any benefit from a carryback must be claimed on an amended return. That must be filed within the normal 3-year statutory period. But here's the catch, or the clipper. Form 1045 is required to be processed by the IRS within 90 days of receipt. Now that's in normal times. I don't know whether they can do anything within 90 days of receipt. I have an amended return that I submitted by certified mail last October 14th. The IRS received the mail on November 15th, and we haven't heard squat about that return since. No inquiry, no acknowledgement, no refund. There's a substantial refund on the amended return, nothing. That time limit virtually assures the 1045 is going to result in getting the economic benefit of a loss in the hands of your client sooner, quicker, if you can meet the filing deadline. So the NOL procedure for examiners, you'll love this. First, ask the taxpayer if the loss was carried back. Make sure you ask the taxpayer what they did before you start your audit. Then review the integrated data retrieval system to see if the IRS records agree with the taxpayer's answer to your question. Then while you're preparing the proposed adjustments report, before you finalize it, go back and take another look at the integrated data retrieval system to be sure that the taxpayer didn't do something while you were busy working on your report that makes your report moot. Finally, when you prepare this report, it should dispose of any and all issues that can possibly be related to that loss. Remember what the 1045 looked like? You're recalculating the taxable income. That's what you have to do. So your NOL might change other limitations, might change other things. I see we have a question in the chat. Thank you for that. Hold on a second. So because the NOL could change other things, we are going to recalculate and make sure that the examiner disposes of all the possible issues. Okay, let's take a look at the chat. Okay. From SH. We received a refund this week from an amended return mailed on 10/8/20 and received by the oh, this is not encouraging me. It never showed up in where's my amended return. Son of a gun. So this is what we should expect longer than 12 months. So you got it this week. That's November, December, January, February. That's 16 months that the IRS is behind. I do have a follow-on question, if you don't mind. And the follow-on question is, did they pay statutory interest with that refund check? Maybe if you're still with me here, the answer comes back, yes, they did. So I guess that's better than a poke in the eye with a sharp stick. Thank you, everyone, for supporting this program and helping me do it. This is something we do together. Let's see if I can get back. What's this? More chat. MK is waiting on one from April of 2020. Had a 1045 that took 9 months to receive a response, which was submitted in August of 2020. When it was recent. 9 months to get a response. August of 2020. Unbelievable. Well, oh, I see. The one of the refunds that one of our colleagues waited on for over a year was a 7-figure refund. Imagine what that does to your relationship with your client, who, unless they're following what's published in the popular press, they're going to believe it's you, that you did something wrong, and we did nothing wrong. So again, thank you. Thank all of you. I really look forward to this every week. You all are making this fun. Let's see if we can, okay. If we can continue to meet for lunch every Thursday at noon, this Zoom call, current information. If you have something you would like covered in this call from the preceding week, if I get the information over the weekend, I'll do my best to get it in the program for everyone. We'll have guest experts on topics. I have a deep bench of people who are smarter than I am about this stuff that I rely on, that I have relationships going back decades, and they're more than happy to help us. Got a question? Maybe someone else in the group can help. That's always a good idea. And of course, you can always mute and unmute to contribute to the discussion, and you can ask a question in chat. So, Catherine, unless we have unless someone is suffering the pains of an undelivered speech, we can call this 3-0 for today.
Yeah.